Right. The present lecture is confined to capital structure and its components as well as the determinants of the capital structure. Let us start with our discussion with the financial structure. Financial structure of a firm is nothing but the left side of the balance sheet of a firm. In other words, the means and sources of the funds so procured. It can be broadly classified into capital structure as well as short-term liabilities. Right. Well, coming to the capital structure. Capital structure is the combination of debt and equity funds. Here, there is no surety in all the capital structure of all companies consists of such a combination. A company may issue only equity shares, another may issue some extent debt and some extent equity. The proportion is there are no standard uniform proportion between debt and equity. How much debt is to be deployed, how much equity is to be deployed is determined by various factors which will be discussed in the next section. While coming to since a capital structure have an option to exercise debt and equity mix, a firm may employ, may not employ the debt. If debt is so employed in a capital structure of a firm, it is known as leverage. Use of, what is meant by debt, the leverage means use of fixed charges sources of funds in a capital structure along with equity. In case a capital structure of a firm consists of only equity, it is an unlevered firm. Unlevered, no lever. In case a firm with debt and equity mix in its capital structure, it is a levered firm. Then what is debt? Debt normally what's called outsider funds. There is a word called outsider funds. It may include what we call the debentures or what we call a long-term loan, and preferential debt is also be considered. Whereas equity means owners' funds, shareholders' funds. It includes equity capital, reserves and surpluses, and also preference debt. Here the question is, shall we consider the preference debt into outsider funds or as an owners' funds? So simple to say, if the shares nature, preference shares nature are non-redeemable, it can be considered as equity funds. Whereas the preference shares, if at all redeemable, their nature appears like an outsider, so it is considered under outsider. Having understood the debt and equity, the leverage, of course, forget leaving the preference shares, debt and equity. What is debt? Debt means maybe a long-term loan or a debenture. Okay. See, the debt and equity mix, if debt is included in the leverage, what capital structure, it is a lever form. What it levers? It enhances the return to the shareholders. As we are all aware, the operating profit, earnings before interest and taxes, therefrom interest on debt is to be paid, then earnings, what we call earnings before tax, therefrom tax is to be paid, then earnings after taxes are there it decides if the company declares the dividend, the preference dividend is paid, the leftover is equity shareholders margin. Margin, funds available to, profit available to, earnings available to equity shareholder. This is the chronological order of the income distribution in a company form of organization. Here, one should keep in mind, here the point of decision, dividend decision, either to distribute the dividend or transfer to reserve, retention is another decision, dividend decision. In case if it declares the dividend, preference shareholder will be paid full, remaining leftover to the equity shareholder. So in this situation, it is a common factor. It is an activity with the distribution process in any company. But whenever the debt capital is component is there in a capital structure, naturally company has to pay some amount of interest on debt. Interest on debt, it is mandated on the company. If it is paid, naturally, if there is an apprehension that it reduces the shareholders' return ultimately because some portion of the profit is absorbed by the interest on debt if debt is included. But in real fact, it will enhance the ultimate returns to the ultimate shareholders. It is nothing but the impact of leverage. It is known as impact of leverage. So, the such impact of leverage can be understood with a case. With a case, right. Let us study the impact of leverage with this case. The Sunrisers India wants to invest 5 lakhs rupees, expecting 24% return, where it has issued the shares. If it wants to issue equity shares, face value would be 10 rupees, and in case debt option is exercised, 15% interest is to be paid, where the tax rate is 60%. First, let us study the impact of debt and equity under different proportions, impact of the leverage on shareholders' return. Here, to study this, to analyze this situation, debt equity proportions are taken where under three options, where it starts with debt 0, equity 100, and debt 50, equity 50, and debt 75, equity 25. So accordingly, the debt capital would be 0 under first option, and it will be increased from 2,50,000 to 3,75,000. Proportionately, the equity capital is 5 lakhs under first option, 2,50,000 under second option, third option is 1,25,000. Here, as already mentioned, interest on debt under three options, it is 50%, whereas expected return on investment is 24%. So, out of this, as per the estimation, 24% on 5 lakhs, the firm will have 1,20,000 rupees income under what we call return on investment under three options. Then, while coming to under such conditions, if 1,20,000 is taken, is considered as a return on investment, where what we call under first option debt capital is 0, whereas 37,500 on 2,50,000 rupees at the rate of 15%, whereas in the third option 3,75,000 at the rate of 15%,
1 lakh, what we call 56,250 are the interest rates. Then accordingly, after deducting the interest from each and every option and then deducting the tax, the earnings after taxes are 48,000, 33,000, 25,500. Then based on that earnings after taxes, earning per share is 96 pice, 1 rupee 32 pice, 2 rupees 4 pice. All it indicates, to the extent of debt increase from 0 to 50, 50 to 75, the earnings shareholders returns are also increased on the rise. Subject to condition, return on investment is 15%, return on investment is always 24% is always higher than the interest payment 15%. So this situation gives a favorable condition to the investors' return in the name of EPS estimation, as we understood. But in the case of the second option that is under question is to study the impact of the leverage on shareholders' return, where return on investment is only 12%, assuming all other conditions are unchanged. So accordingly, the same third option, 75% debt, 25% debt option is taken, but the return on investment is assumed as 12%, but debt interest is estimated as 15% as it is easily taken. If such is the case, return on investment would be 1 lakh instead of 1 lakh 20,000, 60,000 would be there, and the interest payment is one and the same. So accordingly, ultimately, the earnings after taxes and as well as the EPS have been drastically come down from 2 rupees 4 pice to 12 pice. So a comparison between third and fourth option, what it indicates that irrespective of the what we call debt proportion, the returns will have an impact. As long as the interest that have an higher than interest payable on debt is lower than the return on investment up to 1, 2, 3, 4, 1, 2, 3 options, return on investment is 24%, whereas the interest payable on debt rate is 15%, so that there is a positive growth in EPS. When it has reverse, 12% is return on investment, interest on debt is 15%, it gives what we call a negative impact. Finally, it can conclude that always the firm should pay attention, see that return on investment rate should be always higher than what we call interest on debt, irrespective of the debt proportion. At whatever level the debt is exercised, it will have a positive impact. Right.
Having understood the impact of leverage, let us know how to estimate the leverage. Leverage can be measured in two angles. One is degree of operating leverage and degree of financial leverage. Degree of operating leverage is nothing but contribution, proportion between contribution to EBIT. Contribution under marginal costing, it is a center where sales minus variable cost is contribution. Whereas, while coming to the financial leverage, it is a proportion between earnings before interest payment and after payment, as well as the tax also, into 1 minus T. See, before interest payment and after interest payment, the earnings are the proportion that defines the degree of financial leverage. The third one is degree of combined leverage, is the product of degree of combined leverage of degree of operating leverage and financial leverage. Now, say another section under capital structure is indifference point. Indifference point. What is indifference point? See, to understand this, we should assume that a company may have a different combinations in capital structure called portfolio. Maybe equity shares issued by company. Sometimes equity and preference shares may be issued. Some other times equity and preference shares plus debt may be issued. Sometimes only equity and debt may be applied in its capital structure. Whatever the combination, whatever it may be the combination, there the equity shares or equity preference debt or debt and equity, ultimately the EPS estimation is made. So under such conditions, if there are different options are there, different EPSs you will find normally, assuming that a particular combination is applied in capital structure. Under such conditions, say the indifference point is also identified, where the indifference point is under first option and EPS under second option, if both are equal, where EBIT, at what EBIT, the EPS under portion 1 and are under different capital structure forms. The EBIT, if it at what EBIT, the EPS under two different capital structure options, if at all equals, such EBIT is known as indifference point. The indifference point estimation. How to arrive the indifference point? As we understood, indifference point is the EBIT at which the EPS under two options of a capital structure are equal. So let us study how the EPS is estimated. To arrive the EPS at an option 1, only one equity shares are issued in capital structure. Then EPS is EBIT minus EBIT after tax by number of shares. In case in this option 2, equity preference shares are only issued where the EPS estimation is EBIT after tax less preference dividend and the proportion to number of equity shares. Whereas in third option, equity, preference and debt, all three are exercised, then EPS estimation would be earnings before interest and tax, after interest and tax deduction and the preference dividend. After deducting all these, the leftover profit is distributed among equity shareholders. Whereas third option, where only equity and debt are applied, where earnings after interest after tax to the number of shares. So any one of the options we may exercise, where if you to find out what we call indifference point, option 1 and tries to equate option 2, 1 or 3 or 1 or 4, any combination, finally will arrive a value of earning before interest tax. That will be the indifference point. So in this manner, the capital structure in its components and after leverage impact are studied. Now we proceed to components, determinants of the capital structure. So, in simple to say, debt and equity mix under what conditions? It is towards debt or towards equity. Thank you.